Ticker symbol RAVE has increased over 37% in the past year, and today we'll be looking at an upcoming company with a great value composition, which is a small cap growing stock with solid fundamentals, solid efficiency ratios, but it's in a highly competitive sector. So today we'll be looking at RAVE Restaurants, a pizza franchise company. In their annual report, they have the following mission: to facilitate food, equipment, and supply distribution to their franchises. It has a total of 184 franchised pizza restaurants, where 150 of them are domestic and 34 of them are international. They have two main chains, the first one being Pizza Inn, which has different types of units, they call them. The first one is specialized in dining in, so sitting down and ordering your pizza at your table. The second one being delivery, and the third one being express carryout services. This third one, they say that they're located mainly in college campuses or in malls. And the second franchise, which is Pie 5, is a dine-in pizza restaurant, which is normally located in high traffic areas and is more premium. So you can think as the first one like a Domino's, and the second one more like a sitting down, a higher quality, more premium pizza restaurant. The first one is to expand the Pizza Inn system, which is their greatest franchises, domestically and internationally, with a focus in the Middle East, they say, because it's a growing sector. And the second strategy is that they currently do not operate any company-owned restaurants, but in the future they intend to do so. So we could maybe be looking at a 2024 when they start opening company-owned restaurants and operating them. Although they operate in a very standard segment, which is restaurants and specialty franchises, they do have very, very solid financial analysis. The first one being a very high return on capital employed for the industry that they are in of 15%. Then they have almost no debt to worry about, as they have an interest coverage ratio of 200 times, and they have a very solid cash conversion ratio of 122%. This cash conversion ratio is basically how well a company manages to turn their net income into free cash flows, which is what us investors will receive at the end of our investment. Then they have an extremely solid profit margin of 65% and an operating margin of 18%, which to be a restaurant business is very, very good. Now moving on, you can see that they had some extremely high revenue in the past. However, they did face some turbulences, and we can see that right now they're starting to recover, with the revenue starting to slowly recover and grow quarter after quarter. What is shining, however, is their operating income, because you can see that although they had such high revenue in the past, their operating income was actually negative. And now, with lower revenues, they have pretty solid operating income and, of course, net income. Their margins are very solid, with a 20% operating margin, which is stable and rising, and a 16% net margin. In terms of their cash flows, they are very good at converting their net income into operating cash flow, as we can see that they're almost the same. They are investing back into the business, but not at a huge scale. And for their financing cash flow, we can see that they are paying back any debt that they had, which right now they're in a position where they don't have almost any leverage. But in terms of the ratios, the return on invested capital and the return on capital employed are looking extremely solid, especially, as we said before, for a restaurant business. When looking at the fundamentals, this company gets a solid 7 out of 8, which is extremely impressive. The first one being that they have low liability risk, or almost no liability risk. Second one being that they have an extremely solid balance sheet, as they can pay all their short-term liabilities with their current assets. Then they're extremely consistent with their cash flows. And of course, this company conducts share buybacks. Very impressive for a small cap company to be conducting share buybacks, but they do. Then this company has a pricing power. They have organic free cash flow growth, which is being funneled through their organic revenue growth, which we have been able to see. The one thing that I'm missing here is, I believe, one of the most important points for the companies that I choose to invest in is its existing moat or competitive advantage. I think that in the world of restaurants, it's extremely hard to get yourself an existing moat or a competitive advantage where you will get the loyalty of customers. Only some sort of companies such as Domino's, Chipotle, Starbucks, or McDonald's have been able to establish themselves, create an existing moat, and gain a competitive advantage. I don't think that RAVE Restaurants right now has a competitive advantage. I may be wrong. However, from my perspective, not having ever eaten at one of their restaurants, I don't believe that they have a competitive advantage. Moving on, their growth potential is huge, as they're a small cap company. They could follow two main routes for growth that we tend to propose in this channel. The first one being geographical expansion, which is one of the strategies that they did mention that they're trying to go for, the expanding domestically and internationally with an eye in the Middle East. However, since this is a small cap and with their current offerings they are having a lot of success, I would focus firstly on the expansion, which is advertising your franchises to get as many people involved and as many locations opened, or take it one step further and the company itself open and operate restaurants as they were suggesting in another one of their strategic points. In terms of valuation, when running a discounted cash flow analysis on this company provided by Alpha Spread, it did show that this company is mildly overvalued by around 20%, with its intrinsic base case value being $1.55. However, when looking at its free cash flow yield of 7.16%, it does state that the company may be at an attractive valuation since it's a lot higher than the long-term inflation rate of 3%. The main risks and possible challenges I see for Rave Restaurants is, first of all, the competitors. They are, as I stated previously, in a very competitive landscape. They are part of a sector which is one of the most competitive sectors that there are out there, and especially when they're going to be a pizza franchised business, they're going against one of the best companies in the entire world, which is Domino's. And I don't believe that Domino's will let anything slide through. They will get extremely competitive if the time comes. However, so far, Rave Restaurants has been managing to keep growing and keep their competitors at large, which are some good signs that this company is establishing a competitive advantage. I don't see any regulation coming up against pizza restaurants, so I will not even consider this a risk. And in terms of performance, this company has been accomplishing performance objectives for a very long time. However, since it's a small cap, it does face or raise the question that its performance may be even more affected by, for example, economic recessions or cyclicality risks than larger companies that can actually withstand the impacts from, for example, a COVID-19 closure again. And in terms of market and economic downturn or cyclicality risks, I do think that whenever there is an economic downturn, people tend to cut off some of the basic things that they enjoy during economic booms, such as dining out, which would directly impact Rave Restaurants. However, I don't see an economic downturn happening anytime soon. So having said that, Rave Restaurant should be safe for the time being. Before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. I believe that this company can provide consistent, predictable, and resilient cash flows, and it has higher return on capital employed, meaning that its management knows exactly how to create value for the investor. However, I did not find a moat or a strong competitive advantage in this company, so I labeled this company as a good company, which may be a good investment. However, it is located in a highly competitive sector. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there's a link in bio for a free stock if you join Trade Republic or Trading 212.